Hello again, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. In our previous video, I asked Professor Nathan Mauck to kind of go over a high-level view of what happens to stocks after earnings announcements. And in that video, he covered UnitedHealth, Elevance, and Taiwan Semiconductor. And in this video, he did a really high-level video there. But in this video, I'm going to do a much more deep look into Elevance and talk about how you should react and how you should handle stock earnings announcements, especially when they're negative. So let's go ahead and go into the last video we did and look at what Elevance looked like just a couple of days ago before the earnings announcement when Professor Mauck did his video. As you can see, Elevance in this video had a very consistent, almost perfect earnings growth rate going forward. And you could see that the stock price tracked that earnings growth. There were periods of undervaluation, which are great times to buy a stock, by the way. And then there were periods of overvaluation, which for a company that grows as consistently as this company was growing, even then you could be looking at making a lot of money in the stock over the longer run. But Elevance stock price reacted dramatically to their earnings announcement. But by the way, it takes a day or two for the analysts to adjust and make their own decisions and adapt to what is actually going on. And here's one of the first things I want to recommend to you. When you're looking at that and you're looking at past stuff like this, don't react. Don't act the day the announcement came out. Take a pause. There's no panic. You don't need to basically do anything on that day. In fact, it makes a lot more sense to let things settle, let the analysts come out with their next forecast, let the company address their earnings announcement, listen to the earnings transcript, and then start conducting some research. And in this video, I'm going to talk about ways I did that, but I want to go into a much deeper look at Elevance than Professor Mauck did in his high-level video where he covered those three companies. So let's take a look at Elevance here, and let's do a couple of things. Let's first of all use our scroll bar, and let's adjust back historically on what this company looked like. And this is going back through the 2022 fiscal year. And again, we had average growth there of about 13.5%, which is exceptional. This white line is the dividend. They started paying a dividend in 2011 of $1 a share, and you can see that dividend has increased every single year throughout this time. It's actually gone from $1 a share to over almost $6 a share by the end of 2023. Okay, so this is almost a perfect execution of a company that I like to see. Earnings growth was so consistent. They did flatline during the Great Recession, and that's very similar to what we're going to see today, by the way. I want to bring your attention to that. Earnings flatlined, and there was a reaction to the stock price. So let's put weekly stock prices on the graph and look what happened. Coming into the recession of 08 and 09, the stock price did drop, and it stayed low, and it stayed at a low valuation. You can see PE ratios of single-digit levels here for 4 or 5 years until it finally got back close to a 15 PE ratio or above a 15 PE ratio by January of 2015. Okay, but if you're looking at performance here, the company's performance was once again exemplary. But coming out of the recession, people were really traumatized by that Great Recession, but yet a company like Elevance had very, very little operating weakness there. And then in 2011, they initiated their dividend, and then, of course, over the next couple of years, we saw the stock price rise. Okay, now let's move it forward here, and let's look at where we are today. Okay, in contrast to the $37 a share that was expected on earnings growth in 2024, and that would be going back to Professor Mauck's, they were looking at $37.25 for earnings for this year, while the earnings now are expected to only be $33, about $4 less. But I want you to put this in perspective, okay? This is still going to be the second most profitable year in the company's history. Okay, it's not going out of business. It's not bleeding red ink. It's not collapsing as a business. Earnings have just flattened to where there's going to be virtually zero growth from 2023 to 2024. In fact, technically, it'll be a slight drop from $33.14 to the current expectation of $33.02. And this was also company's guidance, by the way. The company guided to that number. Now, the company also talked about what they expect to happen in the future. Now, let's go to the forecasting calculator a moment and let's see some adjustments were made here. Okay, again, we saw $37.25 earnings estimates 3 months ago. Now the estimate has dropped to $33.02, which has been the most recent current estimate. And that would actually be a minus, using a little more granularity here. Instead of a zero, it's a minus 0.36% drop, flattening of earnings. Okay, and the stock price, of course, has reacted and dropped rather significantly. Next year, analysts expect a recovery of only about 5.67%. And again, they were expecting $41 a share just 3 months ago and $41.67 6 months ago. But now they're saying $34.89. So that, again, would be a significant drop in what earnings estimates are. But we've also had the stock price drop precipitously. So from a standpoint of going out to future performance, if I go out to end of 2025 with only a modest 5.67% growth rate, if the stock traded at a 15 PE, which it theoretically should, we would end up with a 21.98% annualized rate of return over that period, much higher than you can expect from most stocks and most investments. Now, the following year, they expect over 17% growth. And there are 16 analysts. And now that's down from what they were expecting just a few months ago, 6 months ago, 3 months ago, and currently. Okay, but they're still expecting pretty strong growth, 17% growth. And again, that would give us at a 15 PE a 20% number. If the PE stayed around 12.7, or let's go down to 12, even lower than the current PE, blended PE is 12.7. So let's go down to what would happen if it still only traded at around a 12 multiple. That'd still be a 9% plus number. A 13.5 multiple would give us a 15% number. So what's happened is we've had earnings drop, but we've also had this massive price drop. So from a standpoint of future rates of return, the company still looks very attractive. Now, as I'll talk about in a moment, the company's long-term growth expectation is for 12%. So this is just a trend line 12% graph here. But if you're going out to 2029 and again traded at a 15 multiple, that would give us about a 19% annualized rate of return. Again, at a 12 multiple, like it did before, that would be 14% annualized rate of return. So there is still some potential growth in the stock. But again, I want to make a couple of points here. What I've done, I waited. I announced in the previous video that Nathan Mauck really did the majority of, that I would be doing an update on Elevance. Okay, now let's look at the company from some other different ways here now. Now, number one is the earnings growth has been spectacular, and this is still not, again, the end of the world. Let's be realistic, guys. This is still an A-rated company with only 35% debt to capital, and it's the largest Blue Cross provider in all of the world. It only operates, I think, in 14 states compared to UnitedHealth Group, which is almost broad. And I'm going to look at some of the other healthcare stocks here too, but I want to stick with Elevance here for a while. This is the old Anthem, and the company changed their name because they grow. One of the ways that they've been always growing is by acquisitions, and I'll cover that a little bit in more depth here in a moment. But this company has a lot of growth initiatives. They're struggling a little bit with Medicaid and Medicaid reimbursements, as are all the insurers. But most of them are arguing that it's only a temporary phenomenon. The long-term benefit of Medicaid as a business for these guys, they expect to be real strong. There'll be some adjustments that'll have to be made. But this company also has other opportunities, which I'll cover here in a moment. But let's look at some of that. Let's look at operating cash flow relative to price. Now, cash flow has again been dropping for the last couple of years, but it's still well above the dividend. I want to make that point. So the dividend looks extremely safe from an operating cash flow point of view. From a free cash flow to equity point of view, the dividend also looks very safe. Now, what I've added here is a transaction. On the portfolios that I've been following, Elevance was one of the holdings, and I bought it on August 24th, 2021 at a price of $376.76. Even after this large drop, it's still above that. Okay, but I don't like to value stocks as much on cash flow, most stocks, as I do earnings. But I do like to also want to look at this stock from a standpoint of revenue. The revenue picture is actually much better. Okay, and from a standpoint of they did report 5% revenue growth, even though their earnings dropped. And by the way, let's look at that. Let's go into fiscal fitness here using fast graph again, and let's look at profit margin, okay, because that's something that's obviously been impacted here. And let's evaluate what's happened to their net margin. Their net margin actually decreased in the quarter September 2024. And it decreased again if you go through the earnings transcript and weakened again, but it is expected to recover, okay, for all the reasons that I'll get into. But the point I want to make is, historically, this company, if we look at it from a performance perspective and compare it, for example, to the S&P 500, what we learn is, even after this pretty significant drop in price, it still has outperformed the S&P 500. There's a cumulative change. I like to do it in compound annual growth rate because it puts it in perspective. The company has averaged 9.86% versus the S&P doing 8.29. Now, the earnings growth has been 11.48% versus the S&P's 5.77, and this is going back to the year 2006, okay? Now, I can expand this out maximum, and we now have a 12%, almost 13% earnings growth versus a 7.1% for the S&P 500 over the same time frame. But once again, we have 12% annualized compound annual rate of return on price versus 8.29 for the S&P. So even after this drop, it's done better. But what's also interesting is it's done it at much lower risk, because this is the valuation comparison now. It started undervalued or slightly undervalued during this period from January 15th of 2004 compared to the S&P that was overvalued, trading at a PE ratio of 21. And the S&P has been overvalued. That's the orange line on this graph, where this stock has been undervalued. Now, what does this mean? This means that Elevance has taken significantly less risk. Elevance shareholders have taken significantly less risk than investing in a very highly valued S&P 500 over the period of time, and they outperformed significantly, almost double the actual amount of dollars on a $10,000 investment would have grown to 110 versus 52,000 in the S&P over this time frame. And again, they did it at a much lower level of risk. So the compound growth rate for this company has been 12.75% versus just under 9% for the S&P. But I also want you to point out the yield on cost. Now, if you're a dividend growth investor but looking to the future and you still have a long time to go, you can see that this company's grown their dividend by about 15%, 16% compound dividend growth rate. Now, that probably will drop to maybe to 10 or 12% given expectations of long-term growth, but that would still give you the opportunity, if you're investing for the future and looking for income, to see a stock whose dividend has grown tremendously over time. Okay, but once again, let's reevaluate the company and let's look at it from the perspective of what's it look like now. Flat earnings for this year, but we've already had this huge drop in price. And this is why I say take your time and wait. Let things figure out. If I look at it from the previous standpoint, analysts were expecting really strong numbers for the next 2 or 3 years, and they ran into that Medicaid issue. But Elevance considers that to be a temporary situation, as do most other health insurers. Now, if we go and look at some of the others, UnitedHealth Group is still expected to grow, but I consider this a very highly valued managed healthcare company. If we look at other competitors like Cigna, we'll go into the historical chart here. Cigna is a healthcare services company. It's reasonably valued now. This is one that was also in the portfolio, and I consider it still attractively valued here. And Humana would be another one. Humana actually did have some earnings issues, and you can see how the market was overvaluing the stock, and now with earnings issues, you see that this stock has dramatically corrected, but it is also expected to right itself going forward. And then if we look at another one, a smaller one, Centene, that's a $30 billion market cap with no dividend, it's been undervalued for a long time, and the market's undervaluing it. So healthcare generally has been an undervalued sector, or a fairly valued sector relative to the overall S&P 500. But what's interesting about this is the companies have grown significantly faster than the overall market, and that's due to the consistency and the necessity of the products and services that they provide to their investors. Now, one of the things I get accused of all the time is only looking at the numbers, and that's kind of what I've done here. And they say I ignore all the other factors that are driving the business going forward. Well, let's stop and think about that for a moment. The reason I look at the numbers is because all those other factors that everyone talks about are what ends up creating the numbers. So the thing is, I need to understand what the numbers are going to be. The reasons why are important. And so when I'm doing research now, since Professor Mauck did his video a few days ago, we posted it, I have been gathering some notes and conducting research. Now, one of the things you can always do is you can go right from Fast Graphs, and I subscribe to Morningstar, and I subscribe to Zacks, and I subscribe to the Wall Street Journal. I can also check Google, and I can also check Yahoo. But most importantly, I can also go to the company's website. I can go into investor services here, and I can look at events and presentations, and basically go into these things and just learn about what the company is and what the company's management is expecting. This company obviously has a very strong management team that's produced exemplary performance over a long period of time. But as I went into these other external links, when I checked Morningstar and the Wall Street Journal and Google and especially Yahoo and Seeking Alpha as well, I gathered more research. Now, I made some notes on those. I'm not going to go over all of these with you. I just want you to get the concept. Here's an article that was in Yahoo. And one of the things they talked about is one bright spot for insurers in general is the commercial market, where they contract with employers to cover their workers. Unlike government programs, where insurers have limited control over payment rates, the federal government, the commercial market, they can control their own destiny by raising premiums annually. Insurers should eventually be able to see improved profits in the government-backed programs as well. In Medicare, that requires patience as insurers cut costs where possible and lobby for better rates. So there is a risk there, okay? But so I went through this article on Yahoo, and of course it talked about the company shares dropped 11%, how they missed earnings. Earnings came in at 837 for the quarter versus an estimate of 966. And then I went and started looking at things like what are some of the positive points. Okay, Elevance did report strong revenue, as I mentioned earlier, of over 5%. It's also expanding its individual and family ACA plans in 3 states, which is expected to drive growth in its health benefits and Carelon segments. Carelon RX continues to expand its customer base and recently closed the acquisition of Kroger Specialty Pharmacy. Acquisitions are a point of growth, and we don't know what those acquisitions are going to be now, but we do know that the company is in the business of doing that. So the company itself has stated that they're confident in their long-term growth strategy, expecting to deliver at least 12% growth. Now, there are negative points. They reported the lower earnings due to elevated medical costs in their Medicaid business. They reduced their full-year outlook to $33. Fast Graphs were showing $33.02, same number, reflecting challenges to operating. But they also talk about a lot of other things here. And again, I don't want to bore you with all this, but the company does have financial stability, and it demonstrates strong financial health when you go through their finances. They did have a net income decline. However, they're still generated pretty strong net income. Now, opportunities, expansion in government-sponsored programs, Elevance Health's existing presence in Medicaid and Medicare presents an opportunity for further expansion. With the aging U.S. population and the growing demand for government-sponsored healthcare programs, the company is well positioned to capitalize on this trend and increase its market share. And again, I've mentioned strategic acquisitions. I expect them to continue to do that. Now, obviously, threats to this growth would be regulatory changes. That's always something that these management teams have to deal with. A competitive landscape. It operates in a very competitive industry. I've already showed some of their competitors. But in conclusion, Elevance exhibits a strong market presence and financial stability with opportunities for growth in government-sponsored programs through strategic acquisitions. However, they do face challenges such as decline in net income and rising operational costs. Now, Morningstar, I went through the bulls and bears. I'm not going to continue to go through this. I want you just to see the concept of what I've done when I've gone through research here. Okay, and then there was, from a business strategy and outlook, I want to just cover this a little bit. Elevance continues to capitalize on its enviable position as the exclusive licensee of the Blue Cross Blue Shield brand in 14 different states. And we would argue that Blue Cross Blue Shield is the most recognizable and trusted franchise in the U.S. health industry. And as the largest Blue Cross Shield operator, Elevance ensures a very similar number of medical members as UnitedHealth Group, which is particularly impressive given its limited geographic reach compared with UnitedHealth Group's national network. Okay, and so you can see, and I'm going to not go through the rest of this here, but I also went into AI and I tried to get some impressions of what AI would say when they researched this company. And again, it was formerly known as Anthem. It's a prominent American health insurance provider, operates under the symbol ELV. They had $44.7 billion in the third quarter of 24, marking an increase from $42 billion in revenue in the same period the previous year. I've already highlighted that. Their benefit expense ratio did increase by 270 basis points. They did declare a growing dividend, as this report suggested, reflecting our commitment to returning value to shareholders. Additionally, Elevate's operating cash flow increased to $2.7 billion, demonstrating strong cash generation, etc. And then strategic initiatives and expansion. They have a history of strategic acquisitions. I already covered that. And so, in conclusion, Elevance is a leading health insurer with a strong market position and a commitment to growth through strategic acquisitions and digital health incentives. While the company faces challenges such as regulatory changes and competitive pressures, its financial stability and strategic focus position it well for future success. And I think the bottom line is this is, again, a long-term investment. I'm a long-term investor. I recognize the fact that the earnings flattened and we had some earnings stress. But I also recognize that the company's stock price, I think, or the market reaction to that overreacted to the numbers. As I mentioned, this is still going to be, if it comes in as expected now, of around $33 a share, it'll still be the second most profitable year in the company's history. Looking at it long term, going all the way back to 2004, you can see that the earnings have continued to grow. And even this year, with a slight drop, 0.36%, if you recall, it's still a very profitable company. It still has very profitable growth, and we do still expect to see the dividend growing going forward. All right, so all in all, I rate this stock a buy now, but that doesn't mean instantly today. Okay, as I've checked here, today's price, if I go into Yahoo estimates here and look, the stock is down another 1.47% today. So again, you don't have to panic and you don't have to jump on these things. The key is we've seen the analyst estimates make their adjustments now. Things still look pretty good. The price, we're not going to be able to hit the perfect top or bottom on stocks. That just is unrealistic. Nobody does that well. But what we do see here, so let's analyze what we do see. What we do see is a real good opportunity to invest in this stock now at a low valuation. And if I did build a position today and its stock fell, let's say, further down to here, I'd be, as long as these fundamentals continue to stay like they are, I'd still be interested in adding to it again and lowering my cost basis, trying to get into the very best possible long-term position I could. I can expect continued dividend growth. I expect continued success in the company's business. It's an essential service. And so as a result, I consider this a good long-term investment at these levels, but I would be patiently waiting over the next couple of days or weeks even to see what happens. If the company's things settle down and it starts moving positively, you'll still have time and plenty of time to get into the investment. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, taking a little deeper dive into Elevance, or the old Anthem company, and pointing out what is really going on and how to practically think about these earnings announcements. Stock prices are always going to be volatile. You can see that very clearly when I went through all these stocks that I covered in this video. Volatility is something that's unpredictable and unavoidable. But the point is, fundamentals are much more realistic, much more consistent, and especially things like the dividend. So focus on fundamentals first and exploit other people's folly. Take advantage of stock price weakness when it occurs, especially when fundamentals are still good. Hope you enjoyed this video. If you did, give me a like, ring the bell, and subscribe to our YouTube channel, but also take a look at subscribing to Fast Graphs. What a marvelous tool to help you analyze whether a stock's intrinsic value is attractive or not at whatever level it's currently trading at. Thanks for watching, and we'll talk to you again real soon.